Are you guys looking to invest in commercial real estate? Well, it's a question we get a lot from people that watch all of our content. And so we decided, let's put out some information out there to help provide you guys the resources that you'll need in order to get invested. So this is really going to be dedicated for that person who's interested in getting ready or is ready but doesn't know where to get started. We're going to start off kind of this series of videos with understanding what type of investment I'm going to be looking for and what are some of the key performance metrics that I need to understand before I even talk to my broker, because you want to have a pretty good foundation of knowledge before you start socializing what it is that you're looking for with brokers. So we hope you guys find this informative. Please help us out with the YouTube algorithm by liking the video, subscribing to our content, leave a comment. It just helps us out tremendously. And so without further ado, let's jump into it. So now that you decided that you're ready to get invested in commercial real estate, the first thing you have to do is determine what is it that you want to invest in? What is the asset class that you want to get into? Are you looking for single family residence? Are you looking for a multifamily residence? Are you looking for storage properties, retail, commercial, industrial? Is there one of any of those that appeals to you and it's something that you say to yourself, like, I like this asset class and that's the one I want to start learning about and getting invested in? There's so many different types that you can pick from, but really if you hone in on one of them, at least for your first few deals, it's going to go a really long way. You want to become the subject matter expert and really understand what drives these types of asset classes. So that's going to be the first thing that you want to knock out is what type of asset class is it that I want to go after? Second thing you're going to want to do is, now that you've established what asset class I want to go after, is what status within that asset class that I want to go after. And what I mean by that is, let's say, for example, you wanted to go after multifamily. Are you wanting to go after a multifamily property where the property is in a stabilized situation, meaning it's fully occupied, recently remodeled, just built, and really it's not going to require any work on your part? Or are you looking for a property that's going to have a value add component where you're going to have to roll up your sleeves, do some work, maybe do some renovations, and that could really range. You could go on the value add side, anything from, you know, minor paint job, changing the flooring as units become available, to having to strip the property down to the bare bones, basically down to the studs, and rebuild it. So the value add spectrum is really big, and especially if you're just getting started, maybe something you don't necessarily want to get into, and maybe just kind of grow and evolve into that. But determine primarily, like, do you want to do the value add work or do you want to go after the stabilized? And then obviously the third one is kind of ground up. Like if you want to just take a property, scrape it and build it from the ground up, but you know, that's the heaviest value add that there is. So determine kind of where you want to fall in that spectrum first. So decide on the asset class first, decide on the status and kind of where it is that you want to get into at. All right, so on the asset classes, most of them are relatively similar in terms of the next steps that we're going to talk about, with the exception of your single family residences. Your SFRs, or your residential homes, those are driven primarily through emotion, right? Your buyers are people that are mostly going to be looking to live there for themselves and their families, and they want to be in a certain community, they want to be in a certain school district. There's a lot of non-economic variables that drive that. For you as an investor, if you're going to go after a single family residence though as your investment, the ability to determine what your future sale would look like upon completion of work, or whenever you decide you want to lease it out or ultimately sell the property, that's not going to necessarily be driven based on the same economic metrics as other types of assets. That's going to be one where you're going to rely heavily on your broker to be able to give you market comparables, look at what price per square foot is selling with other homes in the area, go on Zillow or Redfin and see within that zip code what else has been selling that similar square footage, similar bed, bath configuration, and similar status. That's kind of the single family one is a bit of an anomaly in that sense, but the multifamily, the industrial, they're all going to look at different key performance metrics that we'll jump into right now. So now that you've decided what it is that you're looking for, now you get into the next step of it, which is educating yourself, right? What are the KPIs or the key performance indicators that I need to have a thorough understanding of before I even call a broker and tell them that, hey, you know, my name is Michael and I want to go out and buy a piece of commercial property, and can you go out and start looking for me? Because the first thing they're going to come back at you with is a series of questions. And if you don't understand the questions that they're asking you, they're not going to look at you as a serious buyer. So make sure that you educate yourself on what do these metrics mean, how does it affect me, and what are the benchmarks that I want to set for myself so that when I contact a broker, I can actually have a value add, sophisticated conversation with them and give them the confidence that they can go out and find a deal and I know what it is that I'm talking about as an investor. So the first metric is going to be NOI, and it's one of the simplest ones, but to get into the next one, which is cap rate, you have to understand your NOI first. So your NOI, which stands for your net operating income, is effectively your revenue on your rents less your operating expenses. So things like maintenance, repairs, utilities, so on and so forth. And then that net number is your NOI. So what does NOI not include? It does not include your debt service. So it doesn't include your loan payment. So really what you're measuring here with your NOI is the actual efficiency of the property's operations, making sure that on an operational basis, it generates a positive number. Another reason why you want to have a good understanding of your NOI is because that then goes into your cap rate. Your cap rate is probably going to be the primary metric you see promoted on deals. It'll likely be the first one your broker talks to you about. Probably is going to be the first question you should ask, right? Like, what is this property's cap rate look like? With your cap rate, it's going to be your measurement of your net operating income, which is that number we just talked about being your revenue less your expenses, not including debt, against your actual investment amount, or rather your purchase price. This will generate a percentage yield for you, right? It's going to actually come out to like, anywhere between typically like a 3 to 6 cap or 7 cap, somewhere in that, spectrum of numbers. You don't typically see in today's market double-digit cap rates. The reason why it's important is because it gives you a sense of what your return on your investment is going to be without actually having to start underwriting a deal and digging through the numbers. One of the key things that helps with cap rate assessment is determining your cap rate and then looking at what your finance rate would be on a given property. So let's say, for example, we were looking at a property in Los Angeles. Los Angeles may trade at, let's say, a 3 cap. So if I'm going to purchase a property that's a 3 cap, but then I can only borrow at a 3.5 cap, then because my cap rate is less than my financing rate, it's not a deal that I'm actually going to make money on. Because remember, the cap rate shows your income without that loan payment. So if my yield is at 3% based on the cap rate, but my borrowing rate is 3.5, then I'm actually going to come out negative on the payment. So it's a really good metric to actually just give you a sense immediately of what it is that you're looking for. The other thing about cap rates that's important to know is you'll find lower cap rates in your primary markets, and you'll find typically higher cap rate deals in your secondary or tertiary markets. And there's a reason for that. The higher your cap rate on the pro side is that typically it means that you're going to be generating more income, right? So your higher cap rate deals are basically your premium for taking on additional risk in non-primary markets. So if in LA, I'm looking at something that's like a 3 cap, perhaps somewhere in the Midwest, I'm looking at something that's closer to a 6 cap. Well, if I'm driven solely by cash flow, I may be attracted to that 6 cap number in the Midwest, not taking into account there isn't as many folks living in the community. Maybe the economic drivers aren't as strong as they may be in Los Angeles, or a host of variables that warrant the cap rates to be higher in order to get me to invest. But that's a risk factor too, right? So don't just look at cap rates as, oh, I'm going only after high cap rate deals. Remember, there is a risk correlation to those higher cap rates. The other thing to take into account is typically your lower cap rate deals are going to be in the same primary markets where you'll tend to see greater appreciation, right? So again, giving the same comparison, if you were investing in a property in Los Angeles that maybe had a 3 cap, you could probably deduce that likely that market's going to appreciate greater than perhaps, you know, same exact property in the Midwest. And so those are the things you want to just take into account, is that risk relationship to the cap rate, and at the same time, the relationship of income versus capital appreciation on your money. So the next one is your IRR, or your internal rate of return. Now, this is the one that is really important, but it also confuses a lot of people. So I'm going to try to kind of explain this one so that you can have a good idea going forward, because like cap rate, especially when you're looking at investing with, you know, a group, IRR is the number that is oftentimes promoted. So your IRR, in a nutshell, is your annualized return based on the total sequence of cash flow. So basically, let's say that we're investing January 1 and we're putting out $100,000. So that's minus $100,000 day one. But then in year one, I generate $50,000. So now my total for year one is my negative 100 plus my 50, I'm negative 50. Year two, I make another 50. Year three, I make 75, so on and so forth. The point is that it's a systematic measurement of every cash flow sequence that comes into the property. What makes the IRR particularly important is that it also takes into account a point of sale. So let's say, for example, you bought a property today, and you put the $100,000 in, and then you started getting every year's revenue coming in. And then in, let's say, year 10, you decide you're going to sell that property. Well, in year 10, hopefully you would have had appreciation, right? So then you're going to get a lump sum of money coming back in addition to that year's rents your way. So the IRR looks at your investment period, all the cash flows over the period of ownership, and then your sale lump sum amount. And basically, it ends up giving you an annualized percentage that reflects your return on the investment. A simple kind of underlying basis point for you to know is a 15% IRR on every 5 years means you're doubling your money, right? So if you can hit that 15 benchmark on a 5-year window, it's going to double your investment amount, just as like a general rule of thumb. The fourth thing that you're going to want to take into account is your cash on cash yield on the investment. And the reason why your cash on cash yield is important is because it's unlike cap rate, it actually takes into account your debt. Because what you're looking at is your bottom line net income number pushed against your actual capital investment. So if you put in $100,000 and your property generated $10,000, you take the 10 divided by the 100 to get you your actual cash on cash yield for that year. And that $10,000 number, as an example, includes your net after you paid all your operating expenses and all your debt. So it's looking at like the absolute bottom line of what my cash yield is on this particular investment. So just like with any of these, it shouldn't be the only metric you look at, but it should be one of the multiple ones that you have a good understanding of. So as you're looking at properties, or as you're determining what it is that you want to find, you'll know, or you'll want to say to yourself, like, okay, I'm looking for something that can get me like a 7% cash on cash yield. Obviously, the greater the number, the better, but you don't want to be too unrealistic when you speak to a broker about it. So you'll want to have a good sense of what your cash on cash yield expectation is going to be before you start your outreach to your broker. The next one that we want to get into is your gross rent multiplier. Now, the GRM is kind of one that is highly debated, because some people look at it and say it's not relevant. Others look at it as the primary relevance behind their decision on purchasing a piece of real estate, particularly in multifamily where this one applies. I personally would look at it and say it's good to know, but you don't want to determine your decision based on any one variable. You want to look at the picture as a whole. So your GRM, or your gross rent multiplier, helps determine basically your property's worth in the eyes of people that really like this metric. And so basically it looks at your purchase price divided by your gross rental income. And effectively, you want to take whatever that ratio is, or whatever that number is, and use it to compare to other properties within a certain geographic proximity. What you want to avoid doing is looking at a property, for example, in LA that may have a lower GRM versus, a property in another state that doesn't have necessarily the same density of population or whatever, that may have a higher GRM, and basically say, oh my gosh, the LA deal is much better. You want to look at a property perhaps in a certain market of LA and another property within a certain 3-mile radius also in LA to give you a comparison point. Make sure your comparison is apples to apples, because otherwise it could be deceiving. The next metric is your operating expense ratio. And this is one that we actually spend a good amount of time looking at, and one that when we underwrite a property, if the operating expense ratio that's presented to us seems low, we will manually adjust it to be able to be a little bit more conservative in deciding if it's a real estate investment we like or not. So basically, your operating expense ratio takes a look at your income and your expenses, and it says how much of my income is going towards my expenses as a percentage. So for example, are you looking at a deal that's a 10% ratio, right? So where only 10% of your income has to go to pay your operating expenses. And remember, your operating expenses do not include your debt service, right? So this is not inclusive of loan. This is just the operation of the property itself. As a rule of thumb, and this fluctuates based on every kind of property, but typically what we like to do is we like to look at like that 30% number and say if a property's OpEx is below 30%, at the very least, we will adjust it to reflect 30% to be a little bit more conservative. Having said that, there are many deals where the ratio ends up being higher just because of the dynamics of that property itself. So this is kind of one you'll want to know as you go out and start talking to brokers. You want to find a property that is between 30 to 40% of an OpEx ratio, and just have a general knowledge of kind of where that range is. If you're going into a property that's really high, you're going to have to do a lot of work to raise rents in order to offset the expenses of that property. And so these are, again, just some things that you want to be mindful of and start thinking about before you actually contact your broker. The next two metrics are actually not necessarily ones you'll need for your broker, but they're ones you're going to need for your lender. And those are your LTV targets and your debt service coverage ratio. We'll cover those two as well as other information you'll need to know when you speak to your lender in the next video within this series. So we hope you found this useful and beneficial. We'll provide links in the commentary below to give you more information on some of the metrics that we go over so you can read a little bit about it. Please leave any comments so that we can answer some questions that you have, and thank you as always for watching.